Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. Today, we're embarking on a pretty deep dive into the high-stakes financial landscape we're seeing in mid-2025.
Yeah.
It really feels like every major headline right now has a direct, almost undeniable impact on global markets, economies, and even our own individual financial situations, doesn't it?
Oh, absolutely. And what's really critical to grasp here, I think, is the deep interconnectedness of all these things that might seem separate at first glance. We're going to try and unpack everything from, the current pressure cooker of corporate earnings season to these escalating international trade tensions and even some significant shifts in domestic policy. It's all part of one big, incredibly dynamic global system. Understanding how these pieces fit together, that's really key.
Right. And to help us navigate this complex web, we've really dug into a stack of the freshest sources out there, talking about pulling the most important insights from recent articles, all published around July 21st, 2025. Stuff from top-tier outlets like Yahoo Finance, Reuters, CNBC, Bloomberg. So our mission for you, listening in, is to cut through all that noise. We want to equip you with those essential nuggets of knowledge. The goal is you walk away feeling genuinely well-informed about the powerful forces shaping today's financial world, but, without feeling overwhelmed. So we'll just jump right in.
Okay, let's unpack our first big theme, Wall Street's high stakes in this current earnings season. Something feels, different this time around. It's almost like Wall Street has sent this clear message to companies, good just isn't good enough anymore. What exactly are we seeing play out here?
Yeah, that's really the core of it. The fascinating thing we're observing is this disconnect, right, between a company's strong performance and the lack of a positive reaction in its stock price. Even really excellent results aren't proving enough to justify the kind of elevated valuations we've seen building up. I mean, take Netflix. Everyone watches Netflix, right? According to Yahoo Finance, its shares actually fell 5%. And this was despite beating on both revenue and profit, their top and bottom lines, and even raising their full-year guidance.
Wow, 5% drop after beating. That's tough.
It is. And William Blair analyst Ralph Schrackart, he summed it up perfectly. He said, an overall good set of results and guide were not good enough for elevated expectations. Brian Jacobson, chief economist at Annex Wealth Management, he's been very direct about it too. He basically said the biggest risk right now is valuation.
Okay, so if good isn't good enough, what are the actual numbers telling us? Is the market just asking for, way more than companies can realistically deliver right now?
That seems to be it, precisely. The data we're seeing from FactSet, they're a major provider of financial data. It confirms this. S&P 500 earnings growth, it was initially projected just under 5% for Q2. It ticked up a bit to 5.6% as more results came in. But even at 5.6%, that's still the slowest pace of profit growth we've seen since Q4 2023. And while 83% of S&P 500 companies have beaten their EPS estimates, that's earnings per share, a key profit metric, and that 83% is above the 5-year average.
Okay, so they are beating.
They are beating, yes. But here's the catch. The average size of that beat, the earnings surprise, it's 7.9%. And that actually lags the 5-year norm, which is 9.1%.
Okay.
So companies are beating expectations, yes, but by smaller margins than usual. And the market, it clearly wanted more.
It sounds incredibly unforgiving. So for us, the listener,
Right.
What does this actually mean for our own portfolios? Or even just for understanding why the market's moving the way it is?
Well, it means we should probably expect a lot of volatility, as Jacobson warns. He's very clear on this. He said, earnings misses are going to get punished a lot more than usual. I don't think investors have the patience to really deal with companies that are missing any of those estimates. So for your portfolio, it's not just about whether a company makes a profit anymore. It's about how much more profit it makes than everyone expected. That seems to be the new unforgiving bar.
A high bar indeed. And speaking of high stakes, all eyes are now turning to the market's biggest players, aren't they? Those tech giants.
Absolutely. The so-called Magnificent Seven, those companies that really drive market sentiment, they're about to report. You've got Alphabet and Tesla, for instance, reporting on Wednesday. And that timing is pretty crucial because it's just ahead of that August 1st tariff deadline we need to talk about. So these reports will be absolutely pivotal tests for the market's mood.
Okay, that's a perfect transition. Let's talk about the topic that touches almost everyone's pocketbook, global trade. And right now, there's this huge question mark looming. President Trump's pretty aggressive tariff threats and that fast-approaching August 1st deadline. This is where it gets really interesting, I think.
It truly does. U.S. Commerce Secretary Howard Lutnick, he's playing hardball. He's calling August 1st a hard deadline for new tariffs. Though he did kind of hint that talks could still drag on past that date. We'll see. But Trump's threats have been pretty significant. Initially, there was talk of 30% for the EU. Now he seems to be pushing for a minimum of maybe 15, 20%, perhaps even 25% on autos, and a frankly staggering 50% on copper. The EU itself estimates that U.S. duties already cover something like 70% of its exports to the U.S.
70% already. Wow. Are we seeing real-world impacts from this already?
We are. Stellantis, the big automaker, they're expecting a $2.7 billion loss in just the first half of 2025. They're saying it's partly due to these U.S. tariffs, and they've already started cutting back vehicle imports from Mexico and Canada in response. So the adjustments are happening.
Okay, so how is Europe reacting to this hard deadline and the threat of these potentially huge shares? Are they just, sitting back and waiting?
Oh, not at all. The EU is actively preparing some pretty robust retaliation plans. They already have potential tariffs lined up on about $21 billion worth of U.S. goods, things that could be activated quickly. And there's a second list ready, apparently covering $72 billion of American products, things like Boeing aircraft, U.S.-made cars, even bourbon whiskey.
$72 billion. Wow. That's serious.
It is. And what's maybe even more significant is the growing support within the EU for activating their anti-coercion instrument, the ACI. That's a powerful new tool they have. It lets them retaliate in ways that go beyond just tariffs. Think about things like new taxes on U.S. tech giants operating in Europe, or restricting U.S. firms from getting public contracts over there.
So they have options beyond just matching tariffs.
Exactly. Now, Helen Jewell from BlackRock, she suggests that European earnings are, quote, appropriately reflecting tariff risks, meaning the market isn't totally complacent, but she also warns that the market is, her word, fragile. So there's definitely nervousness there.
Fragile.
Yeah.
Okay, but amidst all this talk of trade wars and retaliation, could there be an unexpected winner in this high-stakes game? Is it possible a country could actually benefit from all this friction?
It's certainly possible. And interestingly, the UK seems to have found itself in what CNBC called a sweet spot post-Brexit. You see, they have existing trade deals with the US that include, like, a relatively low 10% car duty and the lowest steel duties. And they've also got that reset deal sorted with the EU. Alex Altman from Lubbock Fine, he suggests that if those EU tariffs on the U.S. did hit something like 30%, the U.K.'s lower tariffs could actually incentivize EU companies to shift some manufacturing to the U.K. He points out the U.K. has a lot of spare manufacturing capacity after Brexit.
So Brexit, which looked like such a headache for so long, could now potentially be an advantage. That's quite a turnaround. But I guess, like with everything in global trade, the reality is probably more complicated, right?
It's a compelling thought, absolutely. But yeah, we need a balanced view here. Karsten Nickel from Teneo, he cautions that, look, the 30% tariffs for the EU, they're not a given. It might not even happen. And even if it did, any major shift in production like that, that's a multi-year, if not decade-long kind of time horizon. It doesn't happen overnight. He also makes the good point that the UK's main economic strength is still really in financial services, not necessarily the high-end manufacturing you see in Germany or Italy. So while it's an interesting strategic position for the UK, that immediate windfall might be limited. For you, the listener, it really just highlights how these trade wars create these incredibly complex dynamics, right? Affecting global supply chains, forcing countries to constantly reposition themselves.
Definitely complex. Okay, let's shift our focus now eastward to Asia. That's a region always buzzing with its own complex economic stories and significant geopolitical tensions. What's caught our eye there?
Well, let's start with China. Bloomberg reported that a massive, truly massive, $167 billion mega dam project is advancing on the Yarlung-Tsangpo River in Tibet. Now, this isn't just an infrastructure project. It's kind of a masterclass in risk versus reward. On one hand, it promises huge economic stimulus boosting sectors like construction, cement, steel, and it aims to provide enormous clean power. We're talking a potential for 70 gigawatts of electricity.
To put that in perspective, that's more than Poland's total electricity capacity.
$167 billion, 70 gigawatts. Those are staggering numbers. But surely a project of that scale, especially on a shared river, comes with significant risks, environmental, geopolitical. Absolutely on both fronts. The Yarlung-Tsangpo Gorge, where this is planned, is a major biodiversity hotspot. So there are really serious environmental concerns about the impact. And geopolitically, yes, it's a major source of tension, particularly with India and Bangladesh downstream, as the river flows into their territories. India has formally, quote, registered its concern with China, and they're actually speeding up their own hydropower projects in response. One Indian minister basically said, China has already started their dam construction, and we cannot sit idle. Interestingly, the announcement of this project even caused China's government bond futures to tumble briefly, as some traders bet on improved economic activity, which reduced the appeal of those safe haven bonds.
Fascinating ripple effects.
Yeah.
What about China's broader economic health and that delicate, often quite fraught relationship with the U.S.?
Right. On the economic front, the People's Bank of China just kept its main lending rates, the LPR, or loan prime rate, steady. This was despite some signs of softening consumer sentiment and slightly slower Q2 GDP growth. GDP came in at 5.2%, which was down just a touch from 5.4% in Q1. GDP, of course, being that key measure of overall economic activity. Now, some analysts, like those at Nomura, are sounding a warning. They're predicting a potential demand cliff in the second half of 2025. They expect GDP growth could drop to around 4.0%, citing things like an export slowdown from U.S. tariffs and ongoing issues in the property sector.
A demand cliff. That sounds worrying. And what about those U.S.-China tensions?
They continue to simmer. Reuters reported that a U.S. Commerce Department employee has apparently been stopped from leaving China for months now. It's over an alleged visa issue, but it's being linked to national security. And this comes alongside Wells Fargo suspending travel to China for its staff after one of its bankers was also banned from leaving the country. Things like this, they definitely have a chilling effect, as the reports say, on U.S. business travel and general sentiment.
Yeah, so despite trade talks sort of continuing in the background, these incidents show that underlying friction is still very much there. What about rare earths? That's an area where China holds immense leverage, right?
Oh, absolutely. And it's a prime example of China's strategic importance in certain sectors. According to Reuters, China's exports of rare earth magnets to the U.S. surged, get this, over 660% in June. This followed that preliminary trade deal, which eased some controls. China just dominates this market, about 90% of rare earth magnet production and refining. And that dominance, well, it gave them leverage. We saw the U.S. roll back some tech restrictions, like allowing NVIDIA to resume shipments of its H20 AI chips to China. These magnets are just vital for so many things: electric vehicles, wind turbines, even humanoid robotics like Tesla's Optimus, which apparently faced some production disruptions because of shortages earlier.
So that leverage is real, and the U.S. response.
Well, the U.S. is definitely trying to bolster its own supply chain. We're seeing more focus on things like recycling initiatives. There was a recent deal mentioned between Apple and MP Materials on that front.
Okay, let's pivot now to Japan. Their economy seems to be in such a unique spot, especially after their recent election. I mean, they're the world's most indebted developed nation by far, yet their bond yields remain incredibly low. How do they manage to sort of defy economic gravity?
It really is a fascinating paradox, isn't it? Japan's recent upper house election, yeah, it dealt a bit of a blow to the ruling coalition. That probably makes bigger government spending and deficits more likely, according to analysts. And you're absolutely right. Despite having government debt nearly 2.5 times the size of its entire economy, that debt to GDP ratio is just huge. Their long-term bond yields are surprisingly low. Their 30-year bonds, for example, yield just 3%.
3%? How is that possible with that much debt?
It's a combination of factors, really. You've got the weak yen historically, a legacy of ultra-low interest rates for decades, a recent return to mild inflation, which helps erode debt in real terms, huge domestic savings pools that buy government bonds. Plus, the Bank of Japan's own very aggressive policies, buying up lots of assets. And critically, Japan is a massive net creditor to the rest of the world. They have something like $3.6 trillion invested overseas, about half of that in U.S. assets. All these things kind of anchor their yields. It even makes their low yields somewhat attractive to foreign investors looking for stability, believe it or not.
Incredible. But what about the yen itself? Has it been stable?
No. The yen has seen increased volatility, especially since Trump's tariff announcement back in April. And Japan still faces that August 1st deadline, too, with apparently little progress in their own negotiations with the U.S. So this whole segment, looking at China and Japan, it really highlights that intricate dance, doesn't it? Between economic policy, geopolitical moves, and how they directly impact global trade, investment flows, showing very different national strategies for managing debt and trade.
Absolutely. Okay, let's bring the focus back home to the U.S. Let's talk about changes that might affect you, our listener, maybe a bit more directly. So what does all this global maneuvering mean for your wallet, especially with all the talk about new tax changes here?
Right. Let's talk about what President Trump has called his big, beautiful bill. This includes several pretty key tax changes set for 2025. First off, it made permanent extensions of those 2017 tax cuts. So generally, that means reduced taxes for many people compared to if they'd expired. For instance, the standard deduction, that's the amount of income you can just deduct right off the bat before calculating taxes. It gets a big boost. Up to $15,750 for single filers, $31,500 for married couples filing jointly.
Okay, higher standard deduction. What else?
The child tax credit also sees a bump, up to a maximum of $2,200 per child. And then there are these new temporary deductions just for 2025 through 2028. There's a $6,000 bonus deduction for older Americans, 65 and over. There's also a deduction of up to $25,000 for income from tips, up to $12,500 for overtime income, and up to $10,000 for interest paid on auto loans.
Interesting new deductions there. What about people who itemize, especially with state and local taxes?
Good question. For those who itemize, the state and local tax deduction, the SALT deduction, that limit gets raised significantly up to $40,000 for 2025. That's a big jump from the old $10,000 cap. However, there's this unique wrinkle. Some call it the SALT torpedo. Basically, for folks with incomes between about $500,000 and $600,000, their marginal tax rate actually jumps artificially high to like 45.5%. It creates this weird situation where the income bracket just below that, say $200K to $500, becomes kind of a sweet spot tax-wise, relatively speaking.
Bit complex there. Are there any downsides or, hidden impacts for listeners to watch out for with these changes? It sounds mostly like good news, tax cuts and all, but is there a catch?
Yes, there's a potentially significant one that could impact millions. It's being called the ACA subsidy cliff. You see, the bill didn't extend the boosted premium tax credits for the Affordable Care Act. Those are the subsidies that help people afford their health insurance premiums, which were enhanced during the pandemic. So what this means is, starting in 2026, over 22 million people enrolled in ACA plans could see their premiums go up, possibly quite a bit, if no further action is taken by Congress. They could even lose their subsidies entirely if their income happens to be over 400% of the federal poverty limit. It's a really crucial detail for a lot of households.
Definitely something to keep an eye on. Okay, finally, let's take a quick look at a true market legend, Berkshire Hathaway. How is Warren Buffett's empire doing in this turbulent environment, especially after the recent news about his step-back role? Is it still that rock of stability everyone expects?
Well, it's an interesting moment for Berkshire, that's for sure. Their B shares, the more accessible ones, have actually underperformed the S&P 500 index so far in 2025. They've fallen over 12% since that news about Buffett's exit plan came out on May 3rd, which has basically wiped out their gains for the year to date. Now, Buffett himself, he has actually tempered expectations for continuous outperformance for a while now. He's noted it's just really hard to move the needle significantly with the sheer amount of cash Berkshire has to invest. He said he expects Berkshire to perform slightly better than the average U.S. company over time, but, quote, anything beyond slightly better, though, is wishful thinking.
So managing expectations even from the legend himself.
Exactly. But, and this is a huge but, it's crucial to remember the long-term perspective here. Buffett's track record is unparalleled. Berkshire has basically doubled the S&P 500's average annual return ever since he took control way back in the 1960s. We're talking an overall gain from 1964 to 2024 of, wait for it, 5,502,284%.
5.5 million%. Okay, that puts the recent dip in perspective.
It certainly does. It really reminds us, that even for legendary investors, managing expectations in today's complex market is key. And for everyone listening, understanding how these policy changes can impact your own finances is just so important.
What an incredible deep dive that was. We've really covered a lot of ground, from Wall Street's demanding earnings season to those escalating global trade tensions that could reshape manufacturing, all the way to China's huge infrastructure plays, Japan's unique economic situation, those significant U.S. tax changes, and even a peek into Berkshire Hathaway. It truly is an interconnected tapestry, isn't it?
It absolutely is. The global economy is just this profoundly complex system. You see how market valuations, trade policy, even specific projects like that mega dam in Tibet can send ripples across continents. And the coming weeks, well, they look crucial, particularly with that August 1st tariff deadline still hanging over us and those major tech earnings we mentioned. They'll be really revealing about how these forces continue to shape our financial future.
Makes you wonder, doesn't it? What unexpected connections might you uncover if you look beyond just the main headlines?
That's a great thought to end on. And that's all the time we have for our deep dive today. We hope you feel more informed and maybe a bit more empowered to understand this complex financial world. We'll see you all tomorrow morning with new headlines from major financial magazines.